Hey guys, how are you? Just a quick check-in on the precious metals front. Got a lot of precious metals fans, and I am a gold bull, and I'm also a silver fan. But we do want to highlight one key aspect that comes through when you look at technicals, and this is the relative effect of the industrial component in silver. So if we just take from the bottom of the 2000 lows, this is quite a confusing chart, so let's just break it down for you slowly. And what have we got? So I've gone with the candles for silver, because the question I'm asking is, are we overweight silver too soon? Should we be more God market by value? Should you be 75-25 instead of say 50-50 on your gold silver by value allocation? Again, by value, not by weight, remember. And then roll into silver more midstream clear bull. I think this is going to be a long and lengthy and a real blow off gold and silver event, which is going to be driven by the devaluation of currency on an ongoing basis, with a debt collapse and an entire fiat system going towards a Weimar situation. And if we look up to what was, in our opinion, a truncated version of the bull market of 2011, and that came after QE1, 2, and 3, post the 08-09 subprime events. What we actually saw is gold and silver generally were trading up. The candles are silver. I've also added a blue line just for it to pop, and I've thickened it up a little bit. And these are percentage scales for everyone to be aware. How did everything do? Well, we had, and what's the red line, by the way? So the orange line, gold, stands to reason, and the red line, copper, and the blue is silver, along with a candle chart. So it's mimicking the closes that you're seeing on the candle. When does which one overperform? Well, we actually had a bit of heat creation and industrialization and building that went with the China being the primary engine of growth post the 08-09 and actually even into the run-up of 08-09. So let me restate. As we were getting the blow-off stage of the subprime crisis, copper is one of the most required metals for building, both commercially, especially commercially, but also residential homes. And the industrial demand actually ramped. This was the feel-good factor of 04, 05, 06, 07, pumpermentals on the housing market. And actually, the blue line being silver, the gold or the orange line being gold, what you actually saw is that copper began to overperform here. So we've got three metals on here: high-grade copper, gold, the God market, and then silver itself in blue, orange, red, just to make doubly clear. And we are on the monthly so that we can capture the beginning of the last stage of the flattening of metals, the financialization of everything winning. First we got the dot-com boom, then we got the housing boom, but gold started to stir because there was quite clearly some liquidity. Then after the copper sold off really badly in the events of the downturn of 2009. So whilst copper was overperforming to this point, it's an early indicator of recession. Copper's price selling off bad is an early indicator of real financial problems. And what we actually had is the subprime, you actually got the boost. That was, we were in a hyper mode, and copper was overperforming to both silver and gold, it should be said. Remember, silver is the higher beta, so silver was a little bit higher than gold by overall percentage of growth. Copper was the highest. We had a housing boom in the West, and then post the housing boom, you actually have a low point down here. You have silver down there, and you have gold down there. So gold pulled back the least in subprime, copper the most, and silver kind of in the middle. So interesting discussion. Then we marched on. When we went into the precious metals, the full-blown precious metals boom on a result of the quantitative easing that was being announced during this period, what you actually got is all of them moving up, but you got an outperformance from around here by silver. This is the blue line of silver. and up she goes, silver outperforming, but silver turned, and even though it was still outperforming, it started to come down brutally. When silver starts to come down brutally, you know you're in trouble. And then when it was around the 30s, there was a bit of a hard floor at about 26, and it was bouncing around, descending triangle like this. It was pretty much back to the similar performance of gold. So in that high beta blow-off state where gold was going up, made $1927 at that point, silver made almost 50. It was in around the high 40s. At that point, silver had outperformed from that low and was outperforming both copper and gold. Copper outperformed with the subprime boom and otherwise has been underperforming. Note the sell-off on silver and copper. Copper was below, underperforming. So kind of interesting there. Now what we also want to keep an eye on is, because we're asking the question around silver, should we be more in gold or more in silver as a question? And this is what we are seeing. Sometimes silver has some correlation that can be for a period higher than it is for gold. For example, we got a bit of basing structure over here for gold. Let's go with a straight line. I blew that one out a little bit. You got a bit of basing structure here. As we'd gone into the 2016, that was the collapse of debt for China. So China created a whole bunch of heat during the QE phase when the West was absolutely flattened. It was a depression, by the way. They still haven't started honestly referring to it as a depression, but it was. You had bank failures. You had essentially 2 years of flat or negative growth, even though they tweaked it so that you got a 0.1 on one or two nation states, just so that you didn't have back-to-back recessions. But it was a terrible financial period, and it was a bust. During this period, gold was doing that. You actually had silver coming down, the blue line, and you also had copper coming down. So there was more correlation there, and you're actually getting gold going up. Now, because this is a monthly chart, gold itself almost entirely shrugged off the events of CV19. By the time it had gone down, it had come most of the way back up. Note you don't have the candles for gold. It did have a dip, but it came back inside most of the month. That actually on the line chart of the monthly, it barely did anything. That was not the case with silver. That dipped quite brutally there, as you can see, and copper as well. So gold totally shrugged off. This is the inherent lower volatility, steadier hand of the ultimate money. And actually, since this point over here, as part of the sell-off, they were pretty much hand in hand, silver. Since that point there, 2013, where we had a leaning on both the industrial metals, the precious metals, gold has been the outperformer amongst these three. Silver has both the precious monetized element and the industrial effect in it, and gold has been the outperformer since this point. You can see how it's done from there to there, and you can see similarly how silver's done, and you can then see how copper's done from a lower base. It's done slightly less. However, if you look at those gradients across that whole time, you'll see that the silver line gradient is more similar, just parallel a little higher, starting from a higher point, than it is to the copper gradient, than it is to the gold gradient. So you might argue, and some might argue, that the industrial element has still been a little bit dominant. But that's with one picture time frame in review. You can keep adjusting. Don't forget, this is a monthly chart, and it has the 2000 and lows as its reference point. And as we went largely up, that actually flatters silver and copper, the ones that can go in percentage terms more. If we take a localized high, like the 2021 high, and we drop, say, to a lower time frame, becomes kind of interesting. Here you could argue, well, silver and gold from the localized high had a pullback and are definitely more correlated to the chart than is copper, that actually went on a melt up gone off the chart. No, I can't even rescale it. It's percentage terms on a super higher end rise and was in a full-blown bull market, while silver and gold were largely in the pullback stage. And you wouldn't argue in this instance that silver was more correlated to copper than it is to gold at that particular time framing. So you've got to bear in mind, start points, are they at localized lows, localized highs, a variety of aspects to bear in mind when you're doing these correlation, causation type draws. So there was a pullback in gold and silver, and actually gold is just more stable. Now everybody wants to make the more money, and they say, I can take the risk. The truth of the matter is most people would have been better served in most instances that I have done this by gold. It's only at that super blow-off moment where silver just charges right through. It is, and it's ironic to use a modern example for something that is so old, but it is literally like the alt run in cryptos, for which cryptos are based essentially with mining and everything else on metals. So this is the original market, not the crypto analogy. But sometimes people understand it better when it's put to them another way in a different asset class. Bitcoin spends most of its time being a lower beta, less volatile, and generally doing better in the market since inception. But for that period in an alt run, where you get a super moon and a much higher beta where they can move substantially more. In the bear market, Bitcoin can lose 70, 75%, and these alt tokens can lose 97, 99%, which is pretty brutal. And most people think they want to get into their favorite alt to maximize how much they're going to do. In actual fact, this main bull market outside of Solana, and I don't want to talk too much crypto here on a pure metals trade discussion, most people would have been served better. The Bitcoin dominance has gained. In the same way, and as I stress, the gold and silver markets came well before and are the base case rather than the example case. But I'm just looking at it at a different angle for you. In the most simplest way of saying, when you adjust for volatility, even when silver has given you a better outright return, in most instances, gold has probably been the best one for you to have had on a risk adjusted, volatility adjusted, that's what typically referred to, return. So here, for example, if we just took it from the localized high, where the silver and gold roughly started from the same level, gold is higher, so it's actually delivered a better return, but it's also been less scary and painful. And most people get out at lows in desperation. People close and lose their beliefs near lows. I know you think you're not one of those guys. I know you think you're only selling the tops all the time. You're not. People give up. People sell their silver shares here. They sell their silver stocks here, and they repent. Why? Because economic crises and pain occur during these periods at the lows, and that's when they most need cash for other things. And that's when they sell out and they just have to get anything, make a rent check, do something or other. So it's the pain that forces you out. You can't hold on because other things have to be done and paid. And in most instances, sad to say, if you're not a long-term holder investor that you literally don't touch it, you are selling bottoms, not tops on general, just by virtue of how human nature is. So that's a weekly. Let's just drop down to a daily and see how those correlations have been. And also, given the pure industrial element, it's kind of a semi-precious metal, I suppose, in China to some Chinese, but basically it's an industrial metal. How's copper going now, and what does it mean? Again, I'll take a localized low here just out of curiosity. And because I've chosen a localized low and we've been broadly bullish, you actually have silver, the higher beta version of gold, overperforming. That changed quite dramatically if we just even take a localized high. It's a much closer equation. In fact, gold on this recent pullback has done better than silver. Again, I just want to keep making this point. Start points change the framing of everything quite essentially in terms of this world of, causation, correlation, etc. Don't get too confused. So what has actually been happening is copper has been throwing it down really hard. So I'm going to go to the most recent period here. Localized low, it wouldn't shock me that silver is up after that up move being really high. Localized high there, copper is off the scale down and gold is holding its value better, and silver has sold off very similarly to copper. Now I'm going to drop to an hourly, or let's go 12 hourly, so that you can see that more. What you might argue right now is that actually, while gold was continuing to go up, had a little pullback but continued to go up, silver was being dragged down and over, and kind of was a hybrid in the modern sense. So we're talking in the last few weeks, in the modern sense, it's been more pulled down by the copper effect and the industrial problems than gold was. Yes, it's a higher beta. So when gold trades down, silver will trade down more. It could just be that. But you can see how copper's flagging for us what looks to be a highly recessional period. Let's just pull that into frame again, and you can see how much more correlated it looks for silver recently on the down leg with the copper side of things on the lower time frame, whilst gold is showing a lot more stability. So just to open your mind up to a couple of things in the industrial component, don't forget, we still see silver as a precious metal, and we expect it to have an overperformance period to gold. Yes, but when we go into recessions or demand destroying events, which I would argue is pretty much like the circumstances I think we're finding ourselves in now, in truth, with the data coming out since that run in the metals, what you've got is absolute death to the industrial metal. You are going to get some degree of pullback on gold, and that will be very useful central bank accumulation zone. They'll shed some treasuries, no doubt, and a real hard sell in silver, my apologies, in copper, which is leading to a pretty firm sell-off also in silver. So that's one interesting chart that I just wanted to show you between a kind of only just semi-precious, largely industrial metal, precious metal with an industrial, fairly high industrial component, and then gold, almost largely precious metal storage of wealth and purchase tool of central banks as well. And one of the biggest reasons I think this is happening will be driven by the central bank buying and the divestment in treasuries and debt. So that was one part of what I wanted to show you today on something that's a little bit industrial. It feels remiss not to go and have a look at our favorite gold silver ratio. So we'll drop that in gold here. Now when the gold silver ratio starts heading back up, it's often a time when you would expect that there is pressure on precious metals generally. I'm going to switch on the jaws we've done for you before. We said it was a key event when you broke this, and you are getting a bit of a return move. It is topping out. There's some wicks here, 2 shooting stars. We're on the daily side. You're getting a bit of a return move to that period. But overall, in due course, I would still expect us to roll over to the south side, as we've spoken many times before, on the gold-silver ratio, and expect us to head towards this line, which is the 60. And we'll remind ourselves that it's about to happen with a little bit of an alert. So what you're probably going to get here is maybe a rising wedge or a flag coming out of this. That's the way I've drawn it there, is more like a flag and a degree of return move. This was a strong capitulation. That was a spell of real overperformance from the silver side of things, and we expect to see that come back. But during this period, with copper selling off, what it's also telling us about the economy is interesting. Copper is weak. Copper is really weak, and it's building and infrastructure and all of these things. That is not happening right now. So we go again and let's just do that copper market for you. that is a deeply, deeply abrupt spell of selling. That said, it was in quite an increasing mode. You'll remember we've also paraphrased quarter one being the everything is awesome stage of the statistics that we're getting on days like non-farm payrolls. Q1, everything is awesome. We're fine. Red hot labor market. We need to conquer inflation. All of that speak. And you can see this roughly from, the beginning of the year. You're at February here, a run up in the copper price. And when's the top start coming in? May. We said, well, for H2, very much the data coming out of that is very much more circumspect. Unemployment higher, inflation down, and that data coming out is now affecting post the H2 as we go into H3. May, June is over here. You already had started to top out in May and June, and you were already coming off, which was the trend change in the data that was coming out on non-farm payrolls and other CPI and unemployment related data, pointing to the fact that we have said that the consumer is a lot weaker than many people think. A lot of this purchasing could also have been on status expenditure with the big mega corps and the military industrial complex. Don't forget, bombs and missiles take a lot of copper too, and silver. Okay, and that's a sell-off now that you're seeing coming off in copper that's been quite abrupt. And I think that's a bit of an economic indicator. And that'll be part of the reason why on silver you've seen it soften. The gold-silver ratio go up, and it softened relative to gold's performance, which actually had gold making a new high not so long ago in days against the dollar. Don't forget, it's made new highs against just about every currency now. In fact, all currencies, and it was a new high now against the dollar, but it's been rejected. Bit of a broadening megaphone structure, but we've also said to you that there is a likelihood that pound is going to have a little bit of a honeymoon period. They've got the World Economic Forum leader in there, the person who turned a blind eye to groomer gangs in the north, chief prosecutor, a despicable person, I would argue, probably manages to be more loathsome than Tony Blair. Give him time, he'll manage it, I'm pretty sure, with his condescending little mindset, Starmer. But he's going to get a bit of a honeymoon period for the pound, because we're seeing the pound on the upside against the dollar broadly, we're expecting, even though it's not up to date. We're seeing the pound looking stronger against the euro, and we're also seeing the pound stronger against something like the Australian dollar. In fact, we've got technical setups with FX trades. Just click the link below to come and join us for fiat related trading. Of course, we like the strong component to be the gold element, particularly. But right now, a little bit of a pullback, marginally higher highs 3 times, broadening structure on a slight ascending. Looking up on a bull pole, we could see a little bit more period inside the range. And we warned when we were talking to Elijah, just as the new high had occurred, that we would expect you want to continue to be a gold investor, as it always right now, but that you'd get better fills lower down. And remember, buying at, when we were speaking to him, 2,460, and buying that now at current levels even, and there's still possibility you could get a little bit cheaper, 2,396, just means extra ounces for you. And time to start valuing your savings in ounces of gold. How many ounces of gold have you added to your portfolio? And when you do that risk-adjusted measure that we are showing, gold is the king. We will also be releasing on this channel, by the way, David Wu, an interview with him. And the one thing we did agree on is that he's a gold bull too. So watch that one. He thinks the yen's going to be suddenly very strong. It does get a rest now that the dollar is being weak, because the strength of the dollar was the carry trade element, often with the funding of the yen. So you get a little bit less of that. But so does the euro firm up. for a period, and there's actually still great entries on Euro JPY to be had on what we consider to be a long-term trade, given the interest rate differentials and the technical setups that still have outside targets to reach. So you will, when you get a spell of dollar weakness, get a little bit of relief on the weakness, the pressure on the yen, because of the carry trade, and on the euro. So they're both looking to have upside against the dollar, and we think this could be quite sustained, this dollar weakness. So if that's to happen, you may bounce on the splitter here in gold and head up. It might not be a long pullback. It may, if it was a bit more deep, come back down to these levels. That's a little bit more concerning if we revisit the 2-3, the support that we've had before. But I think given what we are looking at, so let's take a look at that. How long will the dollar be weak? This, of course, is not pleasant watching for all the milkshake fans, but gold is and should be, as final winner, should be the key focus of that theory. And we don't see enough gold bullish talk coming out of that corner, and that's our primary criticism. If that's your theory, gold is the thing. You're actually a gold bull. So here we go. This is the pound versus the dollar. We've shown this, and we feel the pound's going to be, of the fiats, relatively one of the firmest. And this is the honeymoon period for the WEF candidate. A triggering event occurred. You made your first interim. You're pulling back towards the funnel here, and we would expect you to see more trading up to 133, 139, could even see a 1.4 mark. That points to, as we've said, in percentage terms, quite a move. So from our just-in-time entry, let's try get that again. You're talking to the target already in currency terms. Quite a big percentage, 8.19, and if you do typically you don't stop exactly on the target. If you get the round number or get close to the round number of 140, that would be an 8.9% move. And it's similar structures here for the euro, not quite as good, maybe certainly less likelihood of overperformance, possibly even a bit of failure, but it is better set generally than it has been for quite some time. And that is the euro, which we would peg around there. And you'll see the draw there. That's in terms of move from here for the euro against the dollar. This won't be overnight, but you're looking at 116.5, and as I say, a small amount of run through to a round number could take you to about 7.5%. So you're looking at about 7, just under 7 to target, maybe 7.5. And on the pound, you're looking at a bit more. Pound being the star in the fiat bag. You're a star in the fiat bag. What a bag that is. So, I mean, we've even pointed it out that our Australian friends might give up some ground against the pound as well. And that is in a breakout, very close. You see, it drew it exactly where I'd drawn the euro. It's almost spot on. Whoops, give me my draw, please. Let's go here. That's the line we want, and we would move it to around there. So that's a triggering event for the weakening of the Aussie to the pound, which could bring you back above 2s. Again, from the just-in-time entry, this is not involving the dollar now. It's involving the Australian dollar. But that's about a 6% against the Aussie. That points to, because remember when we did the GBP to the USD, it was more than 6%. Again, that still shows that the Aussie itself is likely to be a little stronger than the dollar as well, but just not one of the main beneficiaries of the dollar weakness over here. So again, upside to 205, this key round number-ish, 206 could be run, and that would point to about 6.4%. So not a bad move for the pound as a whole. So the Aussie wouldn't be moving too much against the dollar in its own accord. So what about that USD JPY, for example, given that fall? So you can see there's been a snapback here. It's not going to be endless relief for the yen, I don't fear. It's not too much to report there. Canada didn't do particularly well itself against the yen. It also had a bit of a pullback, so there's a bit of a North American malaise. And because of that pressure being relieved on the carry trade, which is the dollar yen, the borrow cheap, speculate for rewards elsewhere, you actually got a pullback on the euro yen as well. So the yen did get some relief from being a one-way bet for a while. So there is that element. But if we go a little bit further out, the patient people are going to do very, very well, providing they don't forget about the yen. It can just rest for a while and pull back. So the whole weakening of the dollar has provided that relief on the yen trade to a degree. But if we look at this and we go right to the very high element, you will see that we are at a second interim level where we expect a little bit of pullback, but in the long run, this is a monthly chart now, so you can go back for a week or two, and this opinion is still going to be accurate. Only if you don't run this target and you come and invalidate down here, and I truly don't see that happening. So this is actually a fairly flawed currency, the euro. We don't come out cheering for the euro. In fact, all fiats we think are garbage. Some are just less garbage than others. The Singapore dollar, the Swiss franc generally, over many decades. But as a whole, it's a pretty garbage category. And you play them off against each other. Ideally, you want gold against yen, but right now that's not the trade to put on, as yen is getting that pullback. You're going to have a little bit of firmness on the euro. This could pull back a bit more. It could even come back. You've seen pullbacks, but it's been pretty stable, most of the way. You have had those pullbacks. That's about as big as they got. You've made a second interim. Could you have a pullback even a tiny bit larger, and then later just go again? You absolutely could. Don't forget about this trade, because everyone will be forgetting about it as the yen has its moment of pushback because of the dollar weakness, because of the carry trade, and the euro and the pound will grab a little bit of the highlights, particularly the pound. So that's what's going on in the fiat realm at the moment. But it doesn't matter which one of those currencies you're in long term, what you want is gold. Gold, gold, gold. And you can always later, midstream, when it's very clear, and silver is now making a new high and dealt with the $50 mark, start rotating for that super spike period for the new high. And I still expect it to be rejected one more time at the $50 mark. So maybe the best thing to accumulate is the gold. Okay, I hope you enjoyed that video and that update. A little bit of currencies in there for you. This is what we do all the time in the community. We have conversations like this on which current markets, and utilizing HVF method, when is the best timing. As you can see, it wouldn't be a great timing to go short the yen if this pulls back a little bit more. But longer run, after some bottoming anywhere in here, assuming it gets that far, you could go back into the euro yen. And we've said it all along, it's a yen weakness trade, not a dollar dominance trade. You have setups across many currencies against the yen weakness. Don't forget it. I'm going to be sharing an opinion of someone else that is completely different. I don't concur with that yen strength narrative, but he might be talking tactically for a day or a week, and in that instance he could absolutely be right during a pullback of that size, as he would have been right there and there and there. But in the whole, I swim downstream. I don't try catch those key moments where you have a little bit of a reversion against the natural flow of the current. So we trade with the trend, and we are continuation. So watch out for that David Wu commentary, Bank of America macro strategist, and you can catch up with his opinions. Quite a Trump fan, so it's going to be entertaining. Okay, see you later. All good. Muchas gracias, and we'll see you on the next video.